Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Robin Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Main Management LLC. Since 2002, Main has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm.
Our guests today are Kim Arthur and James Maxwell from Main Management, founding partner and vice president of research, respectively. And they had a lot of great stuff to talk about today. What do you think?
Yeah. Well, of course, we should note they are a sponsor of the podcast, and thank you to them for that. And again, we're talking to the president and CEO, that's Kim Arthur, and also the vice president of research, that's James Maxwell. And one of our main topics, particularly when it comes to the wiser investing part of the podcast, is talking about their take on thematic investing, particularly in growth stocks. And they're doing something different. They have a strategy called thematic innovation rotation, and they are doing something pretty clever. And as somebody who tried to build something like that myself, I think what they're doing actually is a better mousetrap. So I thought that was really cool. Also, James talks about highlights from his annual presentation at the Main Management Conference every year. He talks about artificial intelligence. He's obviously deep in the weeds on it, and he makes it really practical for us in this interview. So those are a couple of my big takeaways. And what were some of your takeaways?
Yeah, we had a great conversation on AI that I thought was super interesting to hear from James and his perspective on it. Just how much of a game changer it already is, and then, of course, how much it's still going to be, and how much of that we still really don't know and can't predict what it's going to be. So that was pretty cool. And I also thought they had some great insights on the other side of the podcast, which is the stronger living. Kim talking about keep it simple, talking about sleep, as so many people do. And then James, what he said about not doing your job for the money, because basically you're never going to keep up with those people who are doing it for the passion, which I just saw as an interesting way to think about it.
I wonder how much you got paid to say that. No,
I don't know. Yeah.
No, they had great content in the Stronger Living section. It was great. So let's get started.
All right. Kim, James, welcome to Invest Well, Be Well. Great to have you.
Thank you. Thank you for having us.
Well, gentlemen, as you know, a tradition on this podcast, and Kim, you know very well since you were a guest multiple times on our old podcast, but we need walk-up songs. What's going to set the tone for today's interview?
We got the young buck that picked the music, so I'll let him take it.
The song we chose today was Daft Punk, Harder, Better, Faster, Stronger, which I think plays well into the conversation we're going to be having.
You know, in all these years, we've never had a Daft Punk song on our...
Glad to be the first.
Yeah, awesome. Nice selection.
Yes, very cool. All right, guys. Well, now that we have set that tone, let's dive into today's topics. But before we do, I just want to quickly touch base on your professional journeys, let our listeners know where you're coming from. Kim, like Rusty said, you've been a guest with us before on our prior podcast, but let listeners know about you and Main Management, which happens to be a sponsor of this podcast. Thank you very much. Tell us where you're coming from.
Yeah, thank you, Robin. So I've been in the investment business for 38 years. I know that my young buck next to me is not even near those digits yet. But I always like to remind myself, 1 month into my journey was Black Monday, October of 87. The market dropped 23%. So I kind of looked at that and said, boy, it can't get any worse than that. You know, whatever's in front of me, I think I've got a pretty good taste for when things can go pear-shaped. But I spent my first part of my career, first half, working for a growth-focused firm that got acquired by Bank of America here in San Francisco. And then 23 years ago, started Main Management with two of my other co-founders, which were now $4.6 billion in assets. We've got 25 team members, of which half of them have equity in the firm, which is a key feature. And 70% of our assets are from advisors and 15% mini institutional. And the other key feature, 15% of the money is partner money. So we're invested right alongside the advisors and the mini institutions.
Nice. All right. Well, James, a lot of our listeners are young professionals like you, and I'm sure they'll be super interested to know how you made it into your current seat and what advice you might have for people interested in entering the profession.
Yeah, that's a great question. I would start out, actually, I'm a child of 6 kids, so I have 5 other siblings. I'm the second youngest, so I had plenty of opportunities to kind of walk in the footsteps of giants, so to speak, and see what my siblings did and the people around me did, and kind of realize early on that it's really, really important to figure out what you're passionate about. So all throughout high school and college, that was kind of my number one priority, was figure out what I wanted to do longer term, whether that was doing internships or projects or networking and talking to experts within different industries. The big thing that I was drawn to was markets. I thought they were so interesting during high school and college, just the way that they're able to price everything that's going on in the world into a single kind of value for every security that exists was so fascinating to me. And I actually ended up getting an internship at Maine about 5 years ago. That was when I started. It was in the middle of COVID. It was a very unique experience, but I started as a lowly intern, and now I've been with the team for 5+ years. So very, very happy to be here.
Awesome. All right, guys, let's dive into our main topic. And that is, we all believe that wise investing includes investing in growth assets, which of course includes growth stocks. And again, growth stocks are those that have stronger fundamentals, such as stronger profit margins, higher earnings growth rates. And obviously, Maine management believes in investing in growth stocks. So what do you believe is currently not working about the traditional ways of capturing growth?
Yeah, that is a key question. Now, I look at most of these indexes are very backward looking and not by any fault of themselves. It's just sort of how they get pulled and wrapped up and rolled up. And to steal a comment from Wayne Gretzky, we want to go and be positioned where the puck is going. And so in order to do that, you have to get very comfortable with making some leaps of faith. And the first is looking at the total addressable market, known as the TAM, T-A-M, and those are usually wild guesses to begin with. And the second part you have to figure out is the adoption cycle, where you are. We all know about the really early tech adopters. These are the people that'll buy clunky pieces that don't work very well, whether they're products or services or software, but they are very curious and they kind of drive that adoption cycle. So as you start going through it, it turns out that if it's a successful product, whatever the TAM you thought was, it's significantly bigger. And the market will also give you plenty of time to get into those things during the course of its history or over its life cycle there. So I think that's a key piece there is trying to figure out the lane you want to be in, figure out how big that lane can be, and figure out how early in the adoption, where you are at the front, middle, or end of it.
So for investors who are looking for growth tech companies to invest in, what qualities do you believe differentiate good emerging tech companies from unsuccessful ones?
Yeah, that's a good question. And it's obviously the question that everyone's trying to ask, especially in a very environment where things are changing very quickly. We like to consider ourselves market historians here. So we look back at previous cycles, we look at the market data, the winners and losers of different environments, both kind of short cycles as well as much longer cycles, to try to dig out what those similar qualities might be to today. One of the things that we've done is look back at those historical winners of these very, very long technological cycles. And what you see is that there's kind of several different metrics that you can find parallels to. Of course, every technological revolution is slightly different, but the big ones that we've found is looking first for just pure revenue growth over a long sweep of time, similar to what Kim was talking about on that total addressable market. It's driven by that revenue growth, capturing more of that market share. You also want to look for research and development growth, or R&D. And that's showing those companies are willing to reinvest into their, scalable businesses. They have that kind of dedicated reinvestment mandate where they're not just trying to beat the next quarter, they're trying to beat 5 or 10 years down the line. The third thing that we've actually found is not only are strong revenue estimates important, but revisions to those estimates. So it's kind of that inflection point where you're getting an acceleration of revenue growth, where you're having analysts actually continually raise their estimates of what's possible for these companies. Those three combined with I would say, valuation overlay, making sure you're not picking out the most ridiculous valuations if possible, as well as a diversification mandate, are very important, because we kind of view things like the VC world where it's very, very hard, especially early on, to predict the exact winners and losers of any sort of major change. If you're picking, 10 different companies and 9 are complete failures and 1 is the absolute, huge winner of that cycle, you've actually done pretty well. So that's kind of the philosophy that we go into growth investing with.
Awesome. So we've talked about Main management's philosophy. Let's dive into the process. And this leads us directly into Main strategy, the thematic innovation rotation strategy, which can be captured by the ETF with the ticker symbol TMAT, so TMAT. And TMAT, of course, right now is highly rated by Morningstar. So what makes TMAT different from other thematic ETFs in this space?
Yeah, I would point out too, for people, if you want to learn more about the TMAT, if you go to mainmgtetfs.com/TMAT, we've got prospectuses on there. We've got fact sheets that are on there. The holdings are on there on a daily basis, so you can see the names that James was talking about. So a couple features I think that make it different from other thematics that are out there. I think the first is the purity aspect of it. There's lots of thematics that have been built and they're trying to solve for a single theme, and they need to make sure they have enough liquidity. And so what happens is they have to put names that really aren't in that lane but help out with the liquidity, or they put names that only a very small portion of their business is attributed to that theme, where the rest of it is something else. So that is something that we've tried to solve for. Like James mentioned, we have these factors that we're using to screen through them. We're very comfortable with factors. We've been doing a sector rotation strategy for 23 years that really is built off of fundamental factors. So it's in our DNA. And again, by kind of choosing the theme, making sure that TAM is going to be large enough and you're early enough in the adoption cycle, and then putting on it those factors that James talked about to be able to have the individual names, it allows for a lower overall cost structure. You get the purity piece to it, and then hopefully, we're gonna have broad enough diversification. Some of them aren't going to work because not every one of these names and business plans that people have end up working. But we hope that more will work and less will work.
Yeah. So Main Management has been known as a pioneering ETF strategist for decades now. And you know how to build portfolios with ETFs. But TMAT, again, is built with individual stocks. That's kind of a curveball for many investors. How do you answer that?
Yeah, no, it's a very good point. So a couple things looking backwards. Again, my first half of my career at Montgomery Securities, that was bought by Bank of America, it was all single stocks, all growth oriented. So a lot of expertise that myself and the two other founders that also work there, Jim Considine and Dick Fredericks. So it's kind of in our DNA. Second thing to that is that sector rotation strategy that we've been running for 23 years. Even though it's expressed with sector and sub-industry ETFs, we're very aware of what's under the cover. We constantly know the individual stocks that are under there, the active overweights and underweights that we're taking. So once again, kind of in the DNA that we've been able to do. And so what really happened in this thematic strategy is the fact that the building it with other people's ETFs, they were exceedingly expensive and they didn't have that purity piece. So we really decided to unbundle, so to speak, so that we could really give a much better outcome. And it does appear, we've had in the period that we've been running this as a live ETF, which is now going back to February of 2021, we have found that definitely having changed that feature to it there, it's definitely added a much better client and advisor experience and outcome.
Now, I just want to underscore those points because I, once upon a time, designed a similar strategy and was a portfolio manager of it. And what I tried to do to make it different than the other strategies in the space was make it lower risk, quotation marks around it, that could be defined by beta. But you know what? Honestly, Maine built a better mousetrap because one, I had used ETFs, you stripped out all those costs. And two, because I was using those ETFs, there were some bad companies in there. And again, you took those out. So actually your portfolio, when it comes to this space, had lower risk because you emphasized those fundamental factors. So anyway, I think that's really well done. But now here's the big question though. So sounds great. I understand the philosophy and the process, but what kind of exposure should growth investors aim for with this? So there's no doubt people want exposure to the triple Qs, which of course is exposure to the NASDAQ. But how does TMAT fit with the Qs?
Yeah, that's very good. I find it very complementary. And the reason is the Qs are really a mega cap concentrated portfolio. The top 20 names in the Qs are about 65% of the 100 holdings. So, and they're all mega cap names. So if you look at our piece there, we've got about 100 names. It's mid-cap growth. The overlap between the Qs and the TMAT is exceedingly small. And as James mentioned earlier, there's a lot of names in the portfolio that when you look at them, people will say, it looks like a UFO. I've never seen that name before. And that is exactly what we're trying to get. And so I kind of look at it where it fills the U.S. mid-cap tech growth piece. And probably most people in their current portfolios, if they have growth in tech, they probably don't have any of the names that are inside this.
Yeah. And those names, of course, I mean, it's another way of, like you guys like to say, you're owning the future.
Right. Exactly right.
I'll add a stat on that I think was really interesting there, which is in our current holdings of companies that are over $1 trillion in market cap, that represents around 6 or 7% of the exposure. We have, some exposure to these large names, but it's limited and it's selective. In the QQQ or the NASDAQ 100, it's over 50% of the names in there are over $1 trillion, or 50% of the weighting is over $1 trillion in market cap value. So I think that speaks to kind of the differentiation there.
And that's why I think, Rusty, too, you can get the position where, we've got some small and mid cap. You can have names that have 50 billion in market cap that are inside there. And if they're truly blazing a trail, you can get multiple doubles that can happen out of names like that. Where obviously the big moat companies that have $1 trillion plus in market cap, they've shown that they've been able to grow, but it's going to get tougher when you're $4.5 trillion in market cap already.
This episode of Invest Well, Be Well is brought to you by Maine Management LLC, a pioneer in actively managed ETFs since 2002. Maine Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Maine also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Maine Management for years. I've met thousands of managers over the course of my career, and one quality I really value, they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Maine strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainemgt.com.
So I also want to ask you about the biggest topic in technology at the moment, which is artificial intelligence. James, you've been speaking at the Maine Management Conference each year on the power and usefulness of AI. What were some of the highlights from this year's presentation?
Yeah, thanks. That's a great question. I think personally, I'm a huge proponent of AI. Actually, the night that ChatGPT was released, November 30th, 2022, I made an account and started using it immediately. Was fascinated by the technology, was kind of a follower up until then, but really, really dove in after that fact. I would say the biggest takeaway from this year's presentation is that 2025 is the year of what they're calling agents. And for the listeners not familiar with the idea of what like an agent is or an AI agent is, I would say it's most simply explained by having some thing that can go and do a task for you and come back with maybe further questions or help you complete that larger task. So where you traditionally think about these chatbots like a ChatGPT or whatever you might use as a email rewriter or just a kind of, it's very simple, like you put in a question about what's the capital of France and it comes back with an answer of Paris. The change that you've had over the past 12 months is that these AI systems have gotten much more complex and able to do longer horizon tasks, becoming those closer to those agents where they have a thought process where if you ask a complex question, it can think through the answer before it actually gives it to you. It can use tools where it can search the web based on what it finds. It can maybe search a different question, or it can run code or plug into different databases or different programs within it. So it's really become this multi-purpose tool rather than purely just a, hey, rewrite this email to be nicer for me. I think that's the biggest takeaway that I've found.
So where do you think we are on the curve of AI adoption today? Are we still focused on training models? Are we deploying it in real life? Or are we really starting to realize widespread productivity improvements?
So if you look at the adoption, I think one of the most interesting things for me is it's being very quickly adopted by individuals. A lot of what these researchers have found is that on the kind of enterprise or corporate level, you've seen limited but accelerating adoption. A lot of it's being driven by the individuals at the company where they see the ability to enhance their productivity. So they're making the consumer facing just normal account on these different applications, using it in their day to day, maybe even doing it like under secretly or without even saying anything to their manager. Now you're seeing more corporate adoption, especially in the past year, but I think that's still a kind of overall adoption curve. Is it's being very individually led. Another thing I'll mention is that you're seeing a lot of new use cases being enabled by purely the explosion of intelligent and more intelligent AI models. One of the really interesting things that I've been reading about has been robotics. It's a theme that we have in the thematic. And one of the things that's happening in robotics is traditionally you have these robots, whether you can look at like autonomous vehicles or these robot arms. A lot of them have to be programmed in a very defined, specific way where it's doing this one action over and over, or in the case of autonomous vehicles, it's trained on millions of data points and hours of driving, has to be very mapped out for every single city. If it sees something it's never seen before, it's not really able to handle it. There's all sorts of cases where someone's walking down the street and they have like something that looks like a stop sign on their shirt, and the car freaks out and stops suddenly because it thinks it's the stop sign. If you're a human and you saw someone with a stop sign shirt, you'd kind of say, why are they wearing a stop sign shirt, and move on with your day. So that's kind of a case where the traditional robotics landscape is being changed by these language models. Now that these language models are so smart and sophisticated, and what I was talking about earlier, the agents where they're able to use tools, that you're seeing a use case where you're plugging in these language models, the technology behind ChatGPT, as a sort of brain for these robots that can reason and think, and kind of, even if it's a new thing that it's never seen before, these language models have such strong reasoning and world knowledge that if it sees a stop sign, shirt that someone's wearing, it can say, oh, we should ignore that because that's a stop sign shirt. And next time I see that, I won't react to it. And that's a very, very active thing that's being implemented in robotics, where it's combining different technologies to create a more robust system.
Hey, I gotta admit, one time I was in San Francisco, I took a Waymo, and during rush hour, it took forever to get from point A to point B because it was stopping for every pedestrian. Like every pedestrian knew all they had to do was walk in front of the car, it would stop. But anyway,
I got to tell you now, Rusty, the Waymos here in San Francisco, like James has said, it's been that self-learning that's happened. They are aggressive drivers now. It's like it is so funny to watch how much more aggressive they still, they're still stopping when they see appropriately. But boy, if you better follow the stop signs and follow the crosswalks when you're allowed to walk and not, because if you're not supposed to be walking, that Waymo is coming around at 35 miles an hour and making the turn.
hey, James, I have one more question on AI myself, and that is looking at stocks in that space. So which picks and shovel companies do you favor now? And also, which applications look investable? Not just impressive, but investable.
Yeah, it's a really good question. Obviously, it's top of mind in markets. I would say with something as large of a theme as AI, there's not going to be one winner or loser, or even one winning layer, one, sort of picks and shovels. I think if you look back at, for example, the internet, or even just like before that, the mainframe computer, and how that transition looked like, you had, mainframe computer went to very broadly, like the fiber build out, which very broadly led to the internet, very broadly led to smartphones and something like the App Store. Then you had your Uber and all these different applications on that. I think AI is going to see a very similar type of long-term trajectory where, yes, like today you have your semiconductors as like the most obvious front of mind play on that, NVIDIA or others. And that's been a trade that's occurred over the past 24 months. You also have, related to that, your utilities or your other kind of broader build out of energy infrastructure. You then have your model providers building out those and what capabilities those unlock that previously weren't even able to exist. So I think there's a lot of different pockets of interesting opportunity, and you want exposure kind of across the downstream effects. You don't want just your semiconductors. You don't want just your utilities, right? There's many, many different layers, and it's hard to see what that end game looks like because, you couldn't imagine Uber without the smartphone. You couldn't imagine the smartphone without the internet. So there's all these kind of downstream effects that are very hard to predict at this very moment, but making sure that you're getting exposure to those as they pop up.
Rusty, one interesting thing on that I was reading the other day, healthcare is definitely ripe to be disrupted with AI. Big time. Education too, but both of those face regulatory issues around it. But people will start looking for productivity enhancers. I know James came back from the dentist the other day and he's like, my dentist, he was using AI to read the, to confirm what he thought about the x-ray on his tooth, whether it was a stain or cavity. And you just start thinking about the productivity enhancements that are going to happen where you've got a young kid, and instead of like rushing the kid to the ER or urgent care, where urgent care is kind of taking that over, you can sit down there and have an AI say, let me see the rash. I know exactly what that is there. We've looked into the database here and bang, 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 bang. And I think doctors are starting to, they used to always say, don't come in here, Mr. or Mrs. Google me. But now when you're coming in and saying, no, I'm chat GPTing you with my premium service one, that's actually coming in, and you find out that the doctor's doing the same thing. Mm-hmm. But the other piece that's happened, they thought that the readers of x-rays and MRIs and the lab technicians, that those people would go away. Well, actually what's happened, the price of it has collapsed and the utilization has exploded. So they've actually had to hire even more of these radiologists. So but the pricing has come down, utilization up, and so there's going to be a lot of moving parts for sure.
Yeah. Hey, James, are you sure that was your dentist or was it a robot?
I have to double check on that.
Okay.
Right. So James, AI is still something that's misunderstood in a lot of ways. What do you think some of the biggest myths are that you are correcting in this year's talk?
I think there's a lot of narrative out there where it's almost like people want the AI story to slow down. They want there to be this kind of stalling of progress. So you'll see articles pop up from time to time saying, has AI progress slowed? Is it overextended? Is investment overextending itself? Everything I'm looking at and being a daily user of it, it is certainly not slowed. If anything, it's accelerated in the past year, especially for kind of the amount of work that it's applicable to. I think there's always going to be like one-off cases or niche things that they're eventually going to be solved. I know like current AI systems, particularly weak to word games and like little kind of changes in language, they can fall into traps there just based off the structure of how these things are built, of trying to predict the next word. It's just kind of naturally part of it. But that doesn't mean that it's not helpful to my day-to-day workload, or if I need to work on some long project, having a good starting point, acting as a researcher or acting as something that can write a long code base for me. These are still use cases that exist, even if there are kind of gaps in its capabilities that are very, very niche.
Robin, I would add anecdotally that one of your guests that you and Rusty had on the other day or a couple weeks back, Daryl Ryan, about a month ago, he came into one of our meetings and said, okay, this is it. ChatGPT has peaked out. Well, why is that, Daryl? He said, because my mother just called me up and told me that she's using it. And I said, oh, that's awesome, Daryl. You do realize there's 5 billion, that's with a B, smartphones that have immediate access to using, whether it's ChatGPT, whether it's Gemini, whether it's Grok, you take your flavor. So there's probably a lot more of your mothers that still have to, quote, mothers that still have to be able to adopt it. So that's what people forget. This isn't like the internet back in 2000. After 5 years, there were 30 million people that had access to the internet. Now you've got 5 billion people. It's just staggering what can happen.
All right. So lots of investor enthusiasm over AI and emerging technologies. Clearly, investors are on board that AI is a major game changer. But what is one risk the market is underpricing? And how is Main management managing that? And how's that expressed in the ETF TMAT?
I can help answer that. I would say the biggest thing that we see, and we've discussed this a lot so far, but it's that major concentration you're seeing. It's been a major theme kind of the past couple of years, your Magnificent Seven companies that have done exceedingly well for good reason. I think we aren't proponents to say that these companies are going to fail or that they're even bad companies. I think they're great companies. I think the difference is, though, you can have great companies, but future returns still might be weak on those, especially given, if positioning is one-sided or if valuations get extended. I think there's other places, other areas of the market besides just the Magnificent Seven that you can find not only growth, but very, very strong growth or AI exposure or whatever it is. That's kind of the idea behind the thematic. Is it's not just your pure S&P 500 growth or your QQQ. It's finding areas of the market through these themes that you're getting exposure to these very, very long-term, high growth themes, but it's not just that plain old Magnificent Seven.
Yeah, and Rusty, I would add one other thing on there. It goes back to this diversification. And 4.5 years ago, when we had kind of the last bubble in thematics that happened, you had some of the strategies that were out there that were wrapped together and they were trading at 12 times price to sales. Okay, the equity market's traded about 3 times price to sales right now, which is probably the appropriate metric because a lot of these companies might be early in their career, so they don't have full margins as opposed to looking at a price to earnings ratio. But now, here we are 5 years later, and a lot of these themes are starting to show that they actually have runway. And a lot of those are trading now at a 50% discount off of those valuations. So you're 5 years later, the earnings, meaning the earnings have clearly kept moving apace there. The prices have come down. But again, you're going to have kind of a barbell approach. You'll have some ones that are more picks and shovel style, and they're trading at much cheaper. And then you'll have some of the sexy go growth ones that are trading, very, very expensively. But which again is why you need to have sort of that overall. If you're trying to cherry pick and just pick one name, it might be difficult.
Yeah. All right. So I have been in the industry for only 35 years. So I'm not as experienced as Kim, but I have met probably seriously thousands of money managers. And I love to ask this next question. And that is, how are each of you using TMAT right now in your personal portfolios? And just in general, how are Main employees using TMAT? And a follow-up on that, also, any rules of thumb for advisors and investors in sizing the position?
Yeah, so let me take a stab at that. First of all, I look across our firm with the 24 team members that we have. The median age is probably about 30 years old here. So there is quite a lot of people inside the firm that have it in retirement accounts, and they may have it in taxable accounts too. But it clearly is kind of trying to grab that growth of the future, and you want to kind of put it away and don't look at it on a daily basis. For myself personally and my family, all of my kids have it in their Roth IRAs that they have. I can tell you my dad, who will be, he'll be like 88 this November. He doesn't own a lot of TMAT. But, if he had his own way, maybe he would. So I think it's definitely appropriate to have according to your risk tolerance. Now, I look again at the bigger picture for an advisor. It typically in the U.S. equity markets, mid cap is about 20%. You got large cap 70, mid cap's 20, and small is 10. So I think if you are much younger and have a longer kind of runway in front of you, you can have more than 20 points of your equity allocation that are for U.S. equity that are allocated towards it. If you are further along in that life cycle, you might have something below 20 points that are in it. And then if you're kind of like at the very end there, you might say, I need more of cash flow, and you're not going to get cash flow off of this. So that's typically how we look at it for sizing it, but it should be part of U.S. equities in that mid-cap lane.
Right. The interesting thing about mid-caps, of course, too, is everybody always talks about the long-term small-cap premium, long-term, because obviously small caps have underperformed in recent years. But really, mid-caps are kind of the sweet spot in terms of returns divided by the risk profile. A lot of people...
So right.
Yeah.
So right on that, Rusty.
All right, well, let's switch gears now to our second theme of the show, which is on stronger living. So as Rusty mentioned earlier, Maine talks about owning the future in investing. So how do each of you own your future when it comes to health, family, and general well-being?
So, Robin, I like to keep things extremely simple. And so my kind of philosophy is health comes first, because if I don't have my health, then I can't take care of the next two things, which is family and then business. And so on the health side there, I once again, I put it into three simple buckets. It's sleep, it's the fuel, the quality of food that goes into my body there, and then it's exercise that I use personally for myself to kind of like keep, to de-stress or unpack myself. So I kind of look at that 3 by 3 on both of those, and those I just keep kind of rinse and repeat, and try to keep it very simple. James?
Yeah, I would say very broadly, I try to live my life with intention and with passion. There's a very good Stan Druckenmiller quote about he was asked, I think, recommendations for people trying to enter the finance industry, and he said, if you're doing it for the money, it's very hard to have a successful career, because what you end up having is people that are in the industry doing it purely out of passion. And when times get tough, if you're just doing it for the money, you're going to be outran, out-hustled by the people that are doing it for passion. And because they're doing it, as a pure, living their life with intention, that there's better things that you can do with your time. I think I live to that motto, to that idea very strongly, where everything I'm doing, I'm trying to live with intention and actively doing it because I want to do it, not just because I'm taking life, having life take me by the waves.
That's an awesome quote. I've hired a lot of people over the years, and that's one thing I've always looked for, is that genuine passion, because then it's just not a job, they're just going to get after it. So, all right. Well, Robin just asked an awesome question, but I got to drill down a little bit more on it. So for each of you individually, first, with you, Kim, you mentioned, of course, sleep and diet, but you mentioned exercise. You're obviously really fit. What do you do in the exercise realm? What do you do in that bucket?
Yeah. So for me I think you have to have something that's cardiovascular. So for me, my cardiovascular is bicycling, road biking. And I find I have done that for a number of years. I used to actually race bicycles many moons ago. So that covers my cardiovascular. And then I need to have something sort of like skill-based, adrenaline-based there. So it's skiing. And then, as you and I know, we've both gone out and done surfing. And I've recently been picking up wing foiling, which it's fun to kind of always challenge yourself. So this thing, I mean, I'm just moving from the crawling stage to the almost walking stage, and it's just a lot of fun. So those are some of the things. And then the third bucket that goes into it, I think you have to do a lot of balance and core. So I make sure in my routine that I do tons of core strength, balance strength, and that way I can hopefully stay up with my 5 kids and stay up with young bucks like this. Not physically doing the stuff that he does, but just being able to come in and be present.
I just got to say, I've been in the Maine management office, of course, multiple times. And one thing that's really cool and really stands out and is really different from other investment firms is I think every single office either has a balance board or a wobble board. I love it because I have multiple ones myself. I mean, so it's great. All right, James. So outside of working 80 hours a week, actually, I'm just guessing on that. I got to ask, do you have a personal practice that gives you an edge, not just as a professional, but as a human being?
I think this ties into the passion and intention that I was talking about, but what it is in practice is asking why. So what I kind of mean by that is I like to find out why things are the way that they are, living life with a heavy dose of skepticism and trying to have that intellectual curiosity, I think helps me so much in my day-to-day. I hope that I'm on, my job is to research things for sure. I think that's obviously a part of it, part of my personality. But even in personal relationships or family or health or advice or exercise, whatever it is, thinking about why I'm doing something and why I've been told that's the case has been so important for me.
Makes sense. All right. So because we're on this theme of not only investing, but living well, what do you think some of the parallels are between those two themes, especially between disciplined investing and disciplined living?
I was just thinking from kind of just off the top of the head there, it's like, okay, if you've let your health go and blow up on you, it really doesn't matter on the investing side. You're not going to be around. So I kind of say you need the former in order to be able to experience the latter. But I think with all seriousness, I think that there is a kind of a routine and consistency to the health side that also needs to be applied to the investment side. I think also on that health side, you find out there's lots of times where in the beginning of a workout or, looking at the same meal that you've been eating, it's the right thing for you. You have to know that it is a long run that you're looking at. You can cheat short term on some of the things and go indulge in what you want to, but same thing in investing there. If you don't have that disciplined, consistent process in place that keeps you in the lane that you're supposed to do, you will not be able to deliver to your clients on the promise of the expectation of what that strategy is supposed to do. So that to me is very, very, very key. Yeah, again, you can short term, you can be emotional about some of the health pieces there, but long term, you got to pull that emotion out of it and say, this is the right thing. Same thing on the investment side there. People get into trouble when they kind of let their emotions overtake the facts. And so that's what we kind of focus, or what I focus.
Yeah, I would echo the health being so critically important. You can't ignore the kind of long term just for the short term gain. That's, I think, the biggest thing that I would echo from all of that.
Great, guys. Well, this has been a great conversation. Thanks so much for coming on the show today. Before we let you go, we do want to ask, where can advisors follow your work and continue learning from you?
Yeah, the best place for advisors to go is mainmgt.com. That's our main website. In the upper right-hand corner is a advisor portal. And when they enter the advisor portal, they will have more collateral than they know what to do. And it's also broken out. It's curated according to the platforms that different advisors access their trading and their strategies.
Well, gentlemen, thank you so much for your time today. Again, but thank you for your wisdom. Thank you for your partnership. And of course, thank you for your friendship. We really appreciate it.
Awesome. Robin, Rusty, thank you guys too.
Thank you.
Great.
We'll be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe.
This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well. This episode of Invest Well, Be Well is brought to you by Bonrian Capital, led by my friend and colleague of nearly 10 years, Shana Sissel. Shana was named a top 20 wealth tech CEO in 2025, and it's no surprise. She's passionate, does the work, and knows asset managers, portfolio allocations, and alternatives like few others in the business. She's authentic, tough, and deeply cares about all her stakeholders, the kind of character you'd expect from the daughter of a police officer. If you want an investment manager who combines deep due diligence with innovative solutions and alternative investments, please check out Bonrian Capital at bonriancapital.com.